Hello, friends. How are you doing? I hope you've had a great week so far. I hope you're having wonderful insights from this lecture. So, yeah, grab your notebook and your pen and let's get started on today's lecture. Today's lecture is on chart type. So, there are many different types of charts. And again, like I said, we're getting into the crux of it now. We're getting into the useful information to trade. Every other information is useful to know and have an idea, but may not necessarily be useful to trade. Now, when I say every other, I mean topics like again participants in trading and all that. But everything is important because if you are not using it to trade, you can always have it to start a conversation and network, and your depth of knowledge in these things would express how much study that you've had about the market. So do not take any one of it for granted. So yes, we have different types of charts. There's many hundred. In fact, I feel like with, with you can come up with your own chart type if you like. But for this one, we're going to deal with the three major types of charts. So first of all, which is the oldest, is the line chart. It's almost like an ogive, if you think about it. So a line chart connects the closing price of an asset over a specific period with a simple line. Each point represents the closing price of a time reversal, for example, the daily close. These points are connected to form a continuous line. Advantages: one, it's easy to understand, it's perfect for beginners, highlights the overall trend clearly, ideal for long-term investors who focus on the big pictures. I will reiterate that example because I want to adjust something. So yes, it is easy to understand, but today it is no longer perfect for beginners. I would not advise a beginner to use the line chart. It does highlight the overall trend, it's very easy to see. The line chart is what is used in economic analysis, every other form of data analysis and data presentation, because it's just very easy to understand, especially when it is depicting a trend in something, the rise of inflation or the decrease in inflation, the decrease in food prices. It's just easy. You get it. Once you see the time stamp, the date, maybe from 2010 to 2025, and you see that line chart going down, you just get it. Something has reduced from this period to this period or has increased from. It's just very intuitive. It doesn't need too much explanation. Very simple, very easy to understand. So disadvantages are: one, it does lack detailed information, no high and low or open prices. You can't really judge where the market opened from, where the market closed. It's very hard to get detailed context from the line chart. So it is not ideal for short-term investors who need intraday precision. Actually, it isn't, because precision and more details are necessary to participate in intraday. But it's it's best for long-term investors. It's it's great for identifying major market trends. Again, like I said, it's very intuitive. You can just see it. You can just understand what it says once you see it. So we have the bar chart. Now, the bar chart shows more information than a line chart. The bar chart is the predecessor to the candlesticks. Each bar represents one unit of time. So that could be 1 hour, 1 day, or 1 day, or 10 seconds, or 2 hours, or 4 years. A unit of time can be anything you can think of. And we have bar charts that can represent that. So bar charts contain an open, an high, a low, and a close, often abbreviated as OHLC, and generally it can be called holic. I think that's something that goes around. Just call it holic, so it's easy to remember. Holic: open, high, low, and close. Now, how this works is each bar is drawn as a vertical line from the lowest to the highest price of that period. The left tick shows the opening price, the right tick shows the closing price. If you observe the image by my right, and you see that vertical line from up to down, that straight line from up to down, everything, the horizontal lines on the left, all the horizontal lines on the left, on the black line, for instance, the horizontal line on the left is at the bottom, and then the horizontal line on the right is at the top. So the horizontal line on the left represents the opening price, right? The horizontal line on the right represents the closing price. That little that little drop downwards below the horizontal line is called the low. The one above the horizontal line on the right is called the high. Then for the red line, the horizontal line on the left is the opening price, and the one on the right is the closing price. So the black candle is a bullish candle, the red candle is a bearish candle. So how this works, each bar is drawn as a vertical line from the lowest to the highest price of that period. The left tick shows the opening price, the right tick shows the closing price. Advantages: this one displays full data price, open, high, low, and close. It shows volatility and price range clearly. So preferred by traders using technical analysis, yes. Disadvantages is it's visually more complex than the line chart and harder to spot patterns at first glance compared to a candlestick. So while it contains more data, it is not necessarily more detailed as the next one, which is the candlesticks. A candlestick is similar to a bar chart, but visually more intuitive. Each candle represents price movement within a specific time frame using body and wicks, the shadows. Also, the wicks are also called shadows. So structure, the body shows the opening and close. Wicks show the high and low. Color indicates price direction. Green or white, it can be bullish, so which means that price closed higher than it opened. Red or black means it can be bearish, which means that price closed lower than it opened. Again, the color is, this is just a depiction. You can use any color you like. Once you get on TradingView, you can use any color you like. Advantages: one is it's easy to interpret visually, displays market sentiment clearly, it forms the basis of most modern technical analysis, and it supports pattern recognition. It's easy to identify some very, very, very important patterns on the candlestick. Now, disadvantages is one, it can be noisy, there's too much detail on short time frames, and also it may mislead beginners if viewed without context.
So, yeah, that's what candlesticks are all about. Again, this is just the introductory lecture to what candlestick is. The moment you get on a price chart, it will just be a breeze. It's going to be easy for you to understand and begin to make use of them. So, yeah, it's just understand like the definition of what it is. So let's go to time frames in trading. So a time frame represents the duration of each candlestick, a bar or price movement in on a chart. So what a time frame is trying to indicate is this candlestick now that we're looking at, basically how many hours or what's the time frame or the time unit that it represents. So if this candlestick is going to completely form in 1 hour, that means we're on the 1 hour time frame. So it tells you how much time each data point or candle or bar this in this instance covers. For example, on a 1 minute time frame, each candle shows 1 minute of price action. So that means each candle would represent 1 minute, which means that it will open, it will print, it will go up, go down, go up, go within that one, within 60 seconds, the candle will still be printing. Once the 60 seconds is over, it will go to the next candle. So the closing price of the previous candle will be the opening price of the next candle, and then like that, like that. So each one will be 1 minute. So on a 1 hour chart, each candle shows 1 hour of price action. On the daily chart, each candle shows an entire day. So if you observe the image on the right, these are all possibilities of time frames in trading. There's 1 second, 5, 15, 30 seconds, 1 minute, 3 minutes, 5 minutes. In fact, you can do 7 minutes, 2 minutes, 4 minutes. It's technology has made these things all possible. So the time frame determines how zoomed in or zoomed out your view of the market is. So again, you don't expect that if you're on the 1 minute, you have an idea of what's happening on the 1 month. So if you're on the 1 month, you are pretty much zoomed out. You can, because on the 1 month, each candle is 1 month. So if you just look at 60 candlesticks back, you're looking at 60 months. Looking at 60 months back, and that's about 5 years that you can just visually see by just looking at the 1 month time frame. If you're on the 1 minute, 60 candles back is just an hour back. 60 candle back just represents 1 hour. So you can't compare viewing 1 hour to viewing 5 years, it's different. So the daily as well, 60 candles will be 3 months, 2 months back, that's 60 days. So basically that is how it works on time frame. So why time frames matter? Each time frame tells a different story about the same market. So short term or lower time frame traders, this shows rapid movement useful for scalpers and day traders. So medium term, it balances detail and stability, and it's good for swing traders. Long term, higher time frame, it shows major trends used for position traders and investors. So there are three main types of time frame. There is a lower time frame LTF, there's a medium time frame MTF, and then there's a higher time frame HTF. So these abbreviations for just for ease when talking about it or when using it. So think of it like this: the 1 minute time frame shows what's happening right now, the 1 hour shows what's happening today, and the daily time frame will show the season or the climate trend over a longer period of time. So types of time frames, we have the lower or intraday time frame. So examples are 1 minute, 5 minutes, 15, 30, and the 1 hour. This is usually used by scalpers and day traders. So the advantages of this is many trading opportunities present per day. The profits are usually fast because they have the small moves. Then it gives a detailed view of market fluctuations. You can see what's happening right now, like how it is fluctuating right now. Disadvantages of this is there is more noise and false signal, because if there's a major trend, for instance, if you know what the current weather is like at a certain period, and there is a day goes against it, it doesn't mean that, for instance, if you are in the monsoon or rainy season, and then today's weather report shows sunny and bright, it doesn't mean that we are no longer in the monsoon or rainy season, which means it can still rain. That, like, in fact, it can still rain, and that it doesn't rain that day doesn't mean we are no longer in the rainy season. So the overall picture, the overall idea, or the overall current trend is we are in the rainy season, and that it doesn't rain on one day doesn't mean we are no longer in the rainy season. So if you use the data of one sunny day to judge the season, you'll be in the wrong very quickly, and that's what the lower time frame compared to the higher time frame is like. It shows you current fluctuations, but it does not give you a full picture of the overall market. So disadvantages are there is more noise and false signals. Yes, emotional and it is truly emotionally and mentally demanding, and requires high focus and discipline because it fluctuates rather quickly. You must be focused and you must be disciplined during this trading period. So it's suitable for traders who enjoy fast-paced environments, traders who can monitor the chart frequently, or have a specific period of the day. Remember the lecture on trading sessions or time in trading, when to trade, the lectures on when to trade. So if you remember that lecture, there are specific periods of time during the day that were mentioned. So a short-term trader or a trader using the lower time frames can just focus on these periods for market opportunity. So we have the medium term or swing time frames. Now this is usually the 4 hour and the daily. Sometimes it could be the 8 hour, the 6 hour, depending. So this is used by day traders and swing traders. The advantages of this is that it balances between noise and clarity. So there's a little bit of fluctuation, but you can still have an idea of the larger time frame play. So there are fewer but higher quality opportunities, allows for time for thoughtful analysis. Disadvantages is that fewer trades prints per week. You tend to have one trade per week, two trades per week. There are weeks where you may not even have a trade, maybe one or two trades in 2 weeks. And positions may need to be held overnight. Remember, swing trading is multiple days, sometimes even up to some weeks. So it's suitable for traders with limited time screen. You have a job, you're in school, you can't be on the chart all the time. This is suitable. And it's also suitable for those who want flexibility with stability. Then we have the higher time frames, the higher, the long term, or the position time frames. We generally call them the higher time frames. So examples are the daily, the weekly, and the monthly. Again, you see the daily here because the daily is a kind of bellwether time frame. Everybody kind of uses the daily. It's a time frame, such a powerful time frame. It's a time frame that just has like a life of its own. It's just such a special time frame. A long term or a position trader can decide to use the daily. A medium term trader can use the daily. In fact, a scalper can make use of the daily to understand the current trend. So the daily is, if there was one time frame I would advise you to just jump on and start looking at, it would be the daily. Just look at the daily, enjoy the daily, and the daily is such a time frame that you can use the daily and one other time frame to trade. You can use the daily and the 5 minutes, you can use the daily and the 1 hour, you can use the daily and the weekly. Is just such a beautiful time frame. So advantages of this is it captures the big market trends. You see what's happening overall, and this one usually gives you an idea of fundamental events in the market. You kind of know what's happening in the economy when you look at the higher time frame. You know that, oh, the dollar has been bullish for the past 3 months, for the past 6 months, for the past 1 year. And that's not happening because of technical, it's not happening because of any support or resistance or any technical indicator. It's happening because there is some big reason, some economic reason. So it is less affected by short-term volatility. Yes, a news may come out now and on traders on lower time frame get taken out or get stopped by it. But on the higher time frame, you still can view the overall trend, and even when it changes, it doesn't change instantly. So this is ideal for portfolio or fundamental analysis. So portfolio analysis, you have a large portfolio across multiple asset classes. It's ideal to use an higher time frame because you're not scalping, you're not intraday trading, you're holding positions for value because this ends up being an investment. So the higher time frame is very useful in this regard. So disadvantages is one, there are fewer trading opportunities and requires patience and large stop losses. Yes, it does require large stop losses because you're on the higher time frame. You can expect that your prices of invalidation, which is your stop loss, would be quite high too. And patience, fewer opportunities. A position trader may take 1 or 2 trades a month, 1 or 2 trades in 2 months. That's a very possible thing. Because it's not lower time frame and it's not highly volatile. You don't expect to see moves every day or every other week. So you must be very patient to use the higher time frames. And this is suitable for long-term thinkers, investors, and part-time traders. So we also have something called the multiple time frame analysis, which is a very important topic. So professional traders don't rely on one time frame. Remember what I said about daily? You can use the daily and the 1 hour and the 15 minutes. So you can mix time frames together. They analyze multiple time frames to get a full picture of the market. How this works? One, it's top-down analysis. So you start from a higher time frame to identify the main trend, then zoom into a lower time frame for precise entry and exit point. So example here is you use the daily time frame to check the major trend. So you see that there is an uptrend on the daily time frame. You already decide that it is an uptrend on the daily time frame. I am only going to be looking for buys. Then you drop to the 4 hour and identify pullbacks. Pullbacks are, if we're on an uptrend, remember the lecture on trend and structure. So a pullback is in between the higher high and the higher low. So a pullback is when we are going up, the slight downward movement is what's a pullback. So you identify a pullback on the 4 hour, and then on the 15 minutes you fine tune your entry. So there are many entry patterns. So this is how you can make use of the top-down analysis in trading. So there's a bottom-up approach in trading. This is mostly used by scalpers, but not very popular. So one is you identify the momentum on the lower time frames, and then you go higher to confirm if it is in line with an higher or a medium time frame structure. So that brings us to the end. That brings us to the end of today's lecture. We dealt with time frames in trading, the multiple time frame analysis daily. I specifically touched on the daily time frame. There is the lower time frame, which is mostly used by scalpers, the intraday, which is used by swing traders and day traders, and then there is a higher time frame, which is used by position traders and investors. We also touched on the types of charts. We have the line chart, we have the bar chart, and we have the candlestick. And remember, I said on the candlestick and the bar chart, there is the open, the high, the low, and the close, commonly abbreviated as OHLC, or can be called OLIC. So that's it for today's lecture. I hope you are finding this insightful. Again, This is the theory side of it. Don't get bored. It's easy to get bored in trading. In fact, even when it comes to the technical side, it's only interesting at first. When you begin to learn some deep, hard technical things, it gets boring too. So it's your perseverance, your determination, your decision to study that all matters. So yeah, I wish you all the best, and I wish you a wonderful week. And until the next lecture, which is going to be brokers, until the next lecture, I wish you all peace and good luck.